When you watch a luxury car glide down the highway, it looks like absolute magic.
Oh, completely effortless.
Exactly. But you don't see the thousands of tiny, violent explosions happening inside the engine every single minute just to maintain that illusion of a smooth ride.
Yeah, that is a great way to put it.
Welcome to the Time and Market Deep Dive. A quick reminder before we begin, this deep dive is just for entertainment purposes, so please seek professional advice for any financial decisions.
Right. Always do your own research.
But keep that car engine metaphor in mind because it is, well, it's the perfect lens for what we are unpacking today. We are looking at Uber Technologies in May 2026.
And there's a lot to look at.
There really is. The mission of this deep dive is to look past the glowing headlines of Uber's recent Q1 earnings report to uncover the fascinating and sometimes totally contradictory realities of their business model.
Because the headlines really only tell half the story.
Exactly. We've got a massive stack of sources today. We're pulling from Uber's own Q1 financial transcripts, Wall Street analysis, and some raw data from over 66,000 gig workers.
Which is an incredible data set, by the way.
It's wild. Oh, and we also have some recent updates from the U.S. Supreme Court that we need to get into. Okay, let's unpack this. How does a company that relies entirely on human drivers navigate a future where robots take the wheel, all while fighting retroactive legal battles?
I mean, it's the ultimate corporate balancing act, really. You have to understand that Uber right now is essentially operating in two entirely different timelines simultaneously.
Two timelines? What do you mean by that?
Well, there is the financial reality of today, which is wildly successful, but then there's the existential reality of tomorrow, which is entirely unproven and requires an astronomical amount of capital just to survive.
That is a wild position to be in. I want to start with today's timeline because, frankly, it is looking incredibly lucrative.
Extremely lucrative.
Let's look at their Q1 2026 performance. The market absolutely loved these numbers. The stock popped like 8.3% right after the results, hitting $79.41.
Yeah, Wall Street was thrilled.
But what immediately stood out to me in the sources is that they actually had a slight miss on top-line revenue. They reported $13.2 billion.
Right, which usually scares investors.
Exactly. Usually a revenue miss sends a tech stock tanking right.
Hey.
But Wall Street completely ignored it because of the massive beats on profitability.
The bottom line was just too good to ignore.
We are talking 72 cents in adjusted earnings per share and a staggering $9.8 billion in trailing 12-month free cash flow.
We really need to pause on that free cash flow number because it is the entire key to understanding Uber in 2026.
Right. $9.8 billion is no joke.
Not at all. Just to put that metric in plain English for a second, free cash flow is the actual hard money left in the cash register after all the bills, taxes, and operational costs are paid.
It's the money you can actually use.
Exactly. It's money that is ready to be deployed. Generating nearly $10 billion of it completely changes the nature of a company.
It really is wild, especially if you remember the Uber of like 5 or 10 years ago.
Oh, yeah. Completely different beast.
They were the absolute poster child for cash-burning startups, literally lighting venture capital money on fire to subsidize cheap rides and bankrupt the competition.
Just burning billions to capture market share.
Right. Back then, it was a leaky bucket. But they haven't just patched the leaks. It's like they realized they could charge a cover fee just to stay near the bucket.
That's a great analogy.
They are a self-sustaining ecosystem now. I mean, they just crossed 50 million members on their Uber One subscription.
50 million is massive.
And their ad revenue cracked the $2 billion mark globally. They are swimming in so much cash that they bought back $3 billion of their own stock in a single quarter.
What's fascinating here is the underlying mechanics of how they actually achieved that.
Right. How do you go from burning cash to that level of profit?
Well, you mentioned that slight revenue miss earlier. If you dig into the earnings transcript, they absorbed a $1 billion revenue headwind simply due to a business model and accounting change over in the UK.
Oh, so the revenue didn't actually drop off from a lack of demand?
No, exactly. So the top line number looked a little softer on paper, but their actual underlying costs to deliver a ride improved. This is the holy grail of what happens when a software platform reaches true global scale.
Because they have, what, 199 million active consumers every single month now?
Yes, 199 million. And when you have that many people staring at a screen, you don't just charge them for a car ride anymore.
Right, you start monetizing their attention.
Precisely. You monetize their attention and their habits. That $2 billion in advertising revenue you mentioned, that is incredibly high-margin business.
Because there's barely any overhead for a digital ad.
Exactly. Uber doesn't have to put gas in a car to show you an ad for a restaurant while you wait for your driver.
Yeah.
It is pure profit falling straight to the bottom line.
Wow.
Then you add in the Uber One subscription. When someone pays a monthly fee for Uber One, consumer psychology kicks in.
The sunk cost fallacy.
Exactly. They stop opening the Lyft app entirely because they want to make sure they get their money's worth out of their Uber subscription. Members now account for half of all growth bookings.
Okay, so I am looking at this $9.8 billion mountain of cash, and I'm wondering about their overarching strategy. Have they essentially won the ride-hailing growth game?
That's the big debate right now.
I mean, is their biggest challenge no longer capturing territory, but just figuring out where to put all this cash to defend the moat they've built?
Defending the castle is the perfect way to frame it, because there is an absolute siege happening at the gates right now.
The robotaxis.
Yes. This cash fortress they've built today is the only thing funding their survival against the existential threat of tomorrow, the autonomous vehicle, or AV, revolution.
We really can't talk about ride-sharing in 2026 without talking about the robots.
You really can't. It's the whole future of the industry.
Looking at the landscape and the sources, there is a drastic fundamental difference in strategy between Uber and Lyft here. Uber is taking what they call a platform aggregator approach.
Right.
They've committed over $10 billion to partnerships with more than 30 different AV companies. They already have Waymo vehicles live on the Uber app in Austin and Atlanta.
And they struck a deal with Rivian, too.
Yeah, a deal with Rivian to deploy 10,000 vehicles starting in 2028. They are making it very clear they do not want to build or own the cars. They just want to route the traffic.
Lyft, on the other hand, is taking a much more vertical approach.
How so?
Well, they are integrating AV technology from partners like Mobileye and May Mobility directly into their own FlexDrive fleet ownership model.
So Lyft is actually taking on the hardware.
Yes. We connect this to the bigger picture. This is a massive battle over capital efficiency. Uber wants to remain purely a software layer.
Because software margins are unbeatable.
Right. Software has incredible profit margins because servers don't get flat tires, they don't need insurance, and they don't depreciate like physical cars. Uber's philosophy is let the AV manufacturers spend the billions of dollars figuring out the hardware and the AI.
And Uber just charges a toll for supplying the riders.
Exactly.
So Lyft is taking on the physical burden, hoping that by controlling the actual hardware economics, they can squeeze out a better margin per mile.
That's their bet.
But the landscape is incredibly crowded. I mean, Tesla has officially started Cybercab production down in Texas.
The Cybercab is a huge wild card.
And then there's Waymo, owned by Google, which isn't just partnering with Uber. Waymo is going direct to consumer.
Right, they have their own app now.
Yeah, they have their own dedicated app, and they are launching it in 10 U.S. cities, including massive markets like Phoenix, Los Angeles, and the San Francisco Bay Area.
And this is where Uber's aggregator strategy faces its ultimate test.
Here's where it gets really interesting. Let me play devil's advocate here. If I'm a writer in Los Angeles and I can just open the Waymo app to get a Robotaxi, I don't need Uber at all.
That is a fear, yes.
So why on earth is Uber letting Waymo put cars on the Uber app in places like Austin and Atlanta? Aren't they effectively training their own assassin?
It definitely looks that way on the surface.
I mean, how does Uber survive as a middleman if the company making the robotaxis realizes they can just cut them out and go direct to the consumer?
That is the multi-billion-dollar question, and it really comes down to customer acquisition cost.
Okay, break that down for me.
Uber's bet is that consumer habit is an incredibly difficult moat to cross. They are betting that you, the listener, will always open the Uber app first because your credit card is already in there.
And I already use it for food delivery.
Right, you use it for Uber Eats, you use it for groceries, and it has multiple price points. If Waymo goes it alone in a new city, they have to spend astronomical amounts of marketing money just to get people to download their app and trust their service.
Oh, I see. So Uber's basically saying to Waymo, look, we already have 199 million active users staring at their phones. Let us fill your empty cars immediately, and we both win.
Exactly. It's better than Waymo burning billions trying to steal Uber's customers one by one.
Right.
But the risk of disintermediation, where the supplier eventually just cuts out the middleman entirely, remains the single biggest threat to Uber's long-term survival.
Yeah.
They are buying time.
But you don't build a $9.8 billion war chest to fight the robot wars out of thin air. That cash is generated today,
Yes, it is.
and it is entirely built on the backs of 10 million human earners. If we really want to understand Uber in 2026, we have to look under the hood at the gritty reality of that human network.
I really do.
What is it actually like to drive for Uber while the company prepares for an automated future?
It is a stark contrast to the glowing corporate earnings report, I'll tell you that. We have to look at the data set from Gridwise, which tracks the actual earnings of over 66,000 gig workers.
Breaking down those numbers is eye-opening. According to the data, the median gross pay for an Uber driver is $21.18 per hour.
Right.
And for context, Uber actually pays about $1.70 more per hour than Lyft. On the surface, $21 an hour sounds like a relatively decent, flexible gig.
It does sound decent, but you have to remember that gross pay is essentially a mirage in the gig economy.
Because of the expenses.
Exactly. The actual metric that matters is net pay after expenses. The IRS standard mileage rate for 2026 is 72.5 cents per mile.
And that's not just for gas, right?
No, not at all. That number is critical because it accounts for routine maintenance, specialized insurance, and most importantly, the crippling depreciation of the vehicle itself.
Oh, wow.
When you deduct those real operational costs from that $21.18 gross, a driver's net pay collapses to just $15 to $18 an hour.
You know what really blew my mind in the Gridwise report? The data shows that tips only account for 7% of an Uber driver's earnings.
Yeah, that surprises a lot of people.
I always assumed rideshare tipping was similar to food delivery or sitting at a bar, but it's vastly lower. With food delivery, tips make up closer to 30 or 40% of a driver's earnings. But rideshare passengers apparently just don't tip consistently.
The psychology of the transaction is totally different.
How so?
Well, in food delivery, the tip is often placed up front. It acts as a bid for service to ensure your food arrives hot.
Oh, that makes sense. You're bribing them to be fast.
Exactly. But with a ride, the service is already completed when the prompt to tip appears, and the rider is usually rushing off to their next destination. Because that tip percentage is so low, the driver is almost entirely reliant on the platform's algorithmic base pay and whatever surge pricing is available.
Which means driving for Uber is less like a traditional job and more like day trading your time.
That is exactly what it is.
You can't just casually turn on the app at noon on a Tuesday and expect to make a living wage. You have to ruthlessly play the market.
You really have to know when and where to drive.
The data maps this out perfectly. If you log on during a Tuesday morning, you're looking at a dismal average of $20.01 an hour gross. But if you have the discipline to hold out and drive during the Sunday late-night bar closings, it spikes to $28.89 an hour.
It requires extreme strategic discipline, and you are constantly wrestling with an algorithm that is designed to optimize the network for the passenger, not for your hourly wage.
The airport queue data is the perfect example of that.
Oh, the airport queues are brutal.
The Gridwise report highlighted how the Uber app will push a notification to a driver saying, "Short wait, high earnings," encouraging them to pull into the airport waiting lot.
Right, to ensure a supply of cars.
But if there are 150 cars in that queue at Miami or Atlanta, a driver might sit there for an hour completely unpaid. That unpaid wait time absolutely vaporizes your hourly rate, even if the eventual fare you get is decent.
Because you earn $0 for that hour.
Exactly. The app wants a massive oversupply of cars sitting in that lot, so a passenger stepping off a plane gets a ride in 2 minutes. The algorithm doesn't care that the driver just worked an hour for free.
This is the invisible mechanism that connects the human reality back to the corporate financials we discussed in the first segment.
The $9.8 billion in free cash flow.
Yes. How is Uber achieving record profitability? It's largely because the drivers are heavily subsidizing the network by absorbing the capital cost of the vehicles.
By taking on the depreciation.
Precisely. When a driver puts 40,000 miles a year on their personal car, they are accelerating that asset's depreciation rapidly. It is almost like taking a payday loan against the equity of your own car.
That is a dark way to look at it, but it's true.
Uber gets to claim the revenue of the ride, but the depreciating asset is legally kept off Uber's balance sheet. Those record corporate profits are mathematically tied to the tight margins forced upon these independent contractors.
But pushing that much depreciation and operational costs onto a human workforce for over a decade, it gets noticed.
It certainly does.
That balancing act between corporate profitability and gig worker margins isn't just an academic debate anymore. It has spilled over into the highest courts in the country.
This is where things get really complicated for them legally.
Let's examine the legal overhang that is currently threatening this entire system, specifically the massive wage theft lawsuit out in California.
This raises an important question regarding their whole legal strategy.
The U.S. Supreme Court actually recently denied an appeal from both Uber and Lyft. The companies were trying to sidestep a massive lawsuit brought directly by the California Attorney General and the state's Labor Commission.
And before we get into it, we need to look at this strictly from a neutral legal standpoint.
Absolutely. I want to be absolutely clear with you, the listener. We are just unpacking the arguments provided in the sources impartially. We are not endorsing either side.
Just sticking to the facts of the case.
Right. So the state of California is suing under a labor law known as AB 5. The state's argument is that by misclassifying drivers as independent contractors rather than employees, Uber and Lyft withheld back payments and minimum wage.
That's the core of the state's argument.
California argues this misclassification harms the workers, creates an unfair advantage over competitors, and burdens the public system. On the other side, Uber and Lyft argue that this lawsuit is fundamentally invalid.
Because of the arbitration agreements.
Exactly. The companies point out that the drivers signed binding arbitration agreements when they downloaded the app, meaning any disputes must be handled privately, one-on-one, and not in a massive public court.
The timeline of this lawsuit is also very specific, which is super important for understanding the financial risk.
Right, it doesn't cover the present day.
No, this case only applies to the period before December 15th, 2020.
Why that specific date?
Because that is the exact date when Proposition 22, a voter-passed initiative that legally allowed these companies to classify drivers as contractors, officially took effect in California.
Oh, I see.
So this legal battle is entirely about looking backward at how the companies operated in their startup phase before Prop 22 codified their current model.
This brings up a major point of confusion for me, though. If all these drivers legally signed arbitration agreements when they started driving, why did the Supreme Court deny Uber and Lyft's appeal?
It's a really clever legal move by the state.
I mean, how is this massive trial still moving forward if the contracts say it shouldn't?
It comes down to a fascinating legal mechanic that bypasses the arbitration entirely. The California Appeals Court ruled that the arbitration agreements the drivers signed are, well, irrelevant to this specific case.
Irrelevant? How?
Because the individual drivers aren't actually the ones suing the companies. The state of California itself is bringing the lawsuit.
Oh, wow.
Yeah, the state is acting on its own independent statutory authority to enforce labor laws. And since the state of California never downloaded the Uber app and never signed an arbitration agreement, the state cannot be forced out of a public courtroom.
Wow, so they found a structural workaround to the arbitration shield.
They absolutely did.
So, what does this all mean for the company's future? If they don't reach a settlement, there is a massive trial looming in 2026. Could a retroactive penalty from California actually threaten the pristine financial picture we talked about at the beginning of the show?
It is a significant financial overhang.
Yeah.
The lawsuit covers tens of thousands of drivers over a period of years in one of the most expensive states in the country.
So the damages could be astronomical?
Exactly. If the courts ultimately decide that Uber and Lyft owe back wages, overtime, and civil penalties for that entire pre-2020 period, we're talking about a potentially staggering sum of money.
That would be a huge hit.
It's a ghost from their aggressive startup past coming back to haunt their most profitable era. Even with $9.8 billion in free cash flow, a massive legal judgment fundamentally changes their capital allocation strategy.
It changes everything. It dictates how many shares they can afford to buy back, and it limits how much cash they can deploy into the Robotaxi arms race against Waymo and Tesla.
It ties their hands when they need to be spending on the future.
Bringing this all together, when you look at Uber in May 2026, the duality of this company is just incredible. On one hand, it is an absolute Wall Street darling.
A total success story on paper.
It has transformed from a cash-burning startup into a highly disciplined machine generating record free cash flow. They are monetizing almost 200 million active users through ads and subscriptions.
Yet, on the other hand, that entire financial fortress is balancing precariously on the razor-thin margins of its 10 million human workers.
Right.
And it faces severe dual threats. You have the ghosts of retroactive labor lawsuits and the looming reality of direct-to-consumer robotaxis that could render their core routing service obsolete if consumer habits shift.
It's like Uber is trapped in this incredibly awkward teenage phase of corporate evolution. They aren't the chaotic startup anymore, but they aren't the fully automated utility of the future yet either.
They're stuck in the middle.
I want to leave you with a final thought to mull over. Something that hangs over all this data but isn't explicitly on the balance sheet. Uber's is currently using the profits generated by its human drivers to aggressively fund its transition to an autonomous robotaxi future.
Which is a crazy dynamic.
Think about the underlying psychology of that. How does a company keep 10 million human earners motivated, loyal, and willing to drive through the night today when those exact earners know the company is actively funding the robotic infrastructure designed to permanently replace them tomorrow?
It is an unprecedented labor dynamic.
Yeah.
You're essentially asking a human workforce to fuel the engine of their own obsolescence.
Which brings us right back to our opening image. You look at the sleek digital dashboard of Uber's stock price, and it looks like a perfectly smooth ride.
But under the hood,
Under the hood, there are thousands of tiny volatile explosions happening every single day. The real question for 2026 is, what happens to the ride when the engine realizes it is slowly being swapped out for a new one while speeding down the highway?
that is the multi-billion-dollar question.
Thanks for joining us on this Time and Market Deep Dive. We'll catch you next time.